Okay, so yeah, we have our new account challenge going. We have the account starting balance. So today, I wanted to run through the formulation of the trade plan so we can start with the trading tomorrow. So the trade plan is going to include, what did I write down? Oh, wait, actually, it's all going to be here, right? We're going to start with just a brief concept breakdown of what I'm going to be using in this trade plan. Define like my rules of engagement with this, uh, elements of our market structure that we're looking for, how we're going to find our narrative, and the times of engagement. And then we have the initial entry technique and a continuation entry technique that we're going to be using if we miss the initial entry. And then we have the review of the risk to reward. I might add some more stuff onto the end later. And also, this Notion is going to be public. I will share this with you guys. So you guys will be able to look at this all at the end of the stream. But again, today we'll not be doing any trading. We're just going to be formulating our new trade plan. And yeah, so let's get into it. For our brief concept breakdown, we're like I'm gonna start from scratch, assuming you guys like have an understanding of ICT concepts. You guys have been studying for a good bit, but are like like not as familiar with some of the terms I'm going to be using because for this trading account challenge, I will not be using market maker models. Well, I will be using like a part of them, like and like they're like I'm going to be using them generally, basically. But my entry technique is not going to be a market maker model. I mean, as you can probably see by this this cover and this this icon here, we're going to be trading turtle soups on this. So, what is a turtle soup? We go. Oh, why did I do that? We go. Turtle soups. So, turtle soup is basically a buying of buy stops or sell stops. So that's where we're going to be entering our position. But realistically, I'm going to be entering my position at the higher time frame PD array. So again, this is where we're generally looking for our smart money reversal to happen, the SMR phase of the market maker model, right? So it would be essentially entering as soon as we hit the higher time frame PD array. The reason I'm going to be using this is because, well, I'm comfortable with this as a trading model, and at the same time, I also like am going to be combining this with time to show you guys that like this can like turn into a market maker model with our continuation entry, but our initial entry is going to give us a really good risk to reward in terms of how we're going to be able to find our entries. Now, obviously, this might come with some more losses because you are buying in the manipulation phase as opposed to the general distribution after a change in the state of delivery, right? So we're going to be buying in when price is going to be like if we're long, right? Price is going to be shooting down into like buy stops, and if we go short, price is going to be shooting like up into sell stops. So it's going to be a little scary, but we're going to work through it together, right? So we want to buy again in the higher time frame PD array. So enter our position. And we want to have a sweep of liquidity happen beforehand, or like of generated liquidity, so we know that the market is manipulating into that us and allowing us to enter our position. So the higher time frame PD array is going to be our entry. I'm only going to enter using fair value gaps. Let me put higher time frame, fair value gaps, order blocks, and breaker blocks, or mitigation blocks. So those will be my only methods of entry there for the higher time frame PD arrays. And we want to have this happen at specific times. So again, we're going to be using our times. from the time PDF. Going to be using those. And yeah, that's going to be essentially it. Basically buying or selling at the point of inception as opposed to buying after the market structure shift has occurred. So for our rules of engagement, going to be some pretty key rules here. The first rule is, well, actually I'll make a little list about this, right? Again, like this notion is going to be available for you guys to look at, so you guys can like mechanically understand my trade plan after this live stream, right? So for my rules of engagement, no trading on Mondays or Fridays. Why? It's because price is the least likely to be symmetrical with smart money concepts, at least on Mondays or Fridays. I mean, as if anyone opens their chart today, we can see like price is just going crazy. Like I want to limit my trading to only Tuesdays through Thursdays. We will be participating in the market, and I'm going to be doing it live, so you guys will be able to see again that like every trade I take is going to be, you know, visible for you guys. What's next? Duplicate here. No trading on the day of high impact news. Now I'm going to add to this rule here, right? No trading on the day of high impact news. So that means I'm not going to be trading FOMC. I'm not going to be trading CPI. I'm not going to be trading NFP. I'm not going to be trading like any of these things where the market is super volatile. Now I know like a lot of people take opportunities during these times, but like it's just not for me, right? Like I understand myself to the point where like I know that I get pretty greedy trading on these days because as you can see, if anyone's sat through like the CPI or FOMC price action, you're going to get a lot of, you know, big moves happening in the market. And these are the times where a lot of people tend to get really greedy. So mechanically, like I understand myself, like I can't trade like that. So no trading on the day of high impact news. And also no trading after Wednesday of NFP week. So like after the Wednesday happens, NFP, Thursday and Friday, I will not be trading those. And then for general engagement now, we have no trading outside of a kill zone. So, I mean, I think we all know what kill zones are. Like those are the times where price is going to be delivering to draws on liquidity. So why would you want to trade outside of those, right? I'm only going to be also trading the New York session. And now this is only going to be the New York AM session. And in the kill zone, so our trading time would basically be 8:30 a.m. Here, 8:30 a.m. to 11 a.m. And I'm going to start scanning the market at 8 a.m. So again, this is going to be Tuesdays through Thursdays, only trading in the New York AM session from 8:30 to 11. I could have started at 7, but it's not like, which is like going to be the real New York Open, but it's not going to be the inside the kill zone, so I'm not going to be interested in that. What do we have next? I will not be trading inside days. So inside days, what does an inside day mean? Inside days essentially mean like the asset that I'm trading is going to be trading within the previous daily candle. So I'm doing that because on inside days, like you tend to have a lot less volatility in the market, and the problem with that is that we need volatility to participate in the market in the first place. to make like any of our moves. If we trade inside days, a lot of what that's going to look like is just upside down, like up and down chop. It's going to be a bunch of nonsense. You don't want to trade back and forth. No, you want to trade directionally. At least I do, because the trading model we're taking is going to be buying at buy stops and selling at sell stops. So I want to take one directional trade, and it's not going to be a like rapid like scalping or anything like that. No, like every trade will be planned ahead of time and will be like framed on a higher time frame and then broken down into lower time frames like we teach here in TOTK. So no trading inside days. And that should be about it for the rules of engagement. Does anybody have any questions on these, or do you guys understand where I'm coming from with this? I'm happy to answer like any questions you guys have. Otherwise, I'm going to keep going. Again, this is only going to be the trade plan, no trading today. Okay. Now, for the elements of market structure, am I going to be recording my entire trading? Yes, I am going to be recording the entire trading session, and I might or might not do a breakdown after. It just depends on like the time availability I have. Yep. So, elements of market structure, we're going to be looking into, actually rules of engagement. Another thing I have to add to that is prior session must be choppy. So since we're going to be trading the New York AM session, I'm going to say that the London session, the prior session, must be choppy or exhibit up and down price action for me to engage. The reason being is because the chop, the up and down, right, is the generation of liquidity, is the engineering of liquidity. And so, like, I only want to really trade if the prior session itself is choppy because, like, we're buying at, like, the liquid highs and lows, right? So the buy stops at the top, the sell stops at the bottom, buy and sell side liquidity, right? This is what we're going to be buying in. So if price is already directional, I don't want to chase into a trending day. Or if a potential reversal happens, like I can allow that to happen. But like I can be ready for it as long as the higher time frame permits it, right? But generally the prior session must be choppy. Or I mean, if we go towards a higher time frame draw on liquidity, I'm going to be looking for a reversal there. So I'm going to put that as well. Here we go. Prior session must be choppy or insight. But my higher time frame POIs are most likely going to be only like on the 4-hour time frames and above because I don't really like trading like 1-hour POIs. Those don't give the best expansions. So yeah, a higher time frame POI is going to be from the 4-hour and up for the inside day rule. Like, right. So for the inside day rule, I won't trade if the previous day's low or previous day's high is not broken for that day. These rules, well, I don't think so actually. I don't think the rules will offer me only a few days. It's like because I'm gonna get into like which assets I'm gonna trade. I'm only gonna be trading 2. So essentially, like I'm gonna be looking at either of those and scanning for trades. I'm not gonna be shooting for a large RR either. The reason being is because I am trading like the turtle soup model, which requires me to take on like a good bit of risk to enter my initial position in the first place. But I'm gonna get into the RR later down the line. We have the risk to reward review at the end. It's going to be fairly simple, and I'll just explain it, and then anyone can ask any questions if they want to. But yeah, let's keep going, guys. The elements of market structure. So again, like only trading into choppy or consolidated market structure. We'll have to add this into my brief concept breakdown. So I'm sure most of you guys are familiar with accumulation, manipulation, distribution, right? Now, with distribution being the key word here, manipulation, sorry, because this is where we want to enter our initial trade. We're going to be entering as soon as price hits the higher time frame POI with a stop potentially like below it. So with this in mind, we need the manipulation itself to enter our trade, which is why I'm going to be using the choppy or consolidated market structure to align myself with the market. Elements of market structure, again, we are only looking for higher time frame fair value gaps, order blocks, breaker blocks, or mitigation blocks. That's it. I'm not going to be using volume imbalances. I'm not going to be using inversion gaps. I'm not going to be using hidden fair value gaps. None of that. I'm just going to be using only these on the higher time frame. So basic elements of market structure, and then if we get deeper into it, we're going to be using market maker models to frame our initial bias on the market. So, but we want to be doing this from the higher time frame. So I want to be doing this from the daily, the weekly, the monthly, potentially like the 4 hour. So again, 4 hour and up. If I can't find anything on the 4 hour, but I see some like really good setups, I might go down into the 1 hour, but generally, like, I'm not going to be doing that, right? We want to, I don't want to take trades in rejection blocks, Joker. I'm not gonna do that. Me personally, I haven't found like as much success trading rejection blocks as much as I have with like just regular order blocks. I mean, if it's an order block on a lower time frame, then like I might think about it, but the trade would be like more of a scalp. But I mean, we'll think about that. I can still change this trade plan as we go. Like, this is obviously not a set in stone trade plan, because like, I mean, I'm making it here right now, so it can be changed down the line, right? We're going to be using market maker models, and we're just going to be going from liquidity to liquidity. So again, like, this is using order pairing theory, where like every buy has to be matched with a sell, right? So if we take buy side liquidity, like major buy side liquidity, since I'm going to be using the higher time frame to frame this, I'm going to be targeting sell side liquidity as well. But again, only in the terms of my risk to reward, which I'm going to define later. Okay, boom. So how we're going to find our narrative is we are going to start at Asia. We need it to be consolidating, so choppy conditions. We need that to happen ahead of time in Asia, because if Asia expands, like, I'm not going to be as interested to follow up on it, because London will also probably follow up on the expansion, and then the New York session itself will be choppy. It's either that, or if London expands, the New York session itself is likely to be choppy. I really don't like it when London has like a huge expansion, because I find like the New York AM session is just unbearable to trade, and like during these times, like, since those are my like ideal times to trade, again, like 8:30 starting at 8 o'clock, right? Trades start from 8:30 to 11. I do not want Asia or London to have the daily expansion. I want the expansion to happen during my session. So again, London, we really need our small expansions, choppy conditions, and now if we understand like a daily AMD cycle, right? So again, like, Asia should be our accumulation, London should be the daily manipulation, right? If this is to happen, and London does have like a small expansion, this is why I wrote this here, right? But like a smaller expansion, I'm gonna be looking for a retracement, maybe like an OTE entry in the higher time frame on London, like into London's dealing range, right? So this is ideally what happens in the New York session, right? This is how we're going to define our narrative, either from a retracement or having the manipulation happen here. So this is ideally what I want to happen in order to trade and in order to build narrative. I do want the New York AM session itself to either like manipulate at like again our key time cycles to expand and then go further from there. So we have our times of engagement. Again, I'm going to be engaging, start scanning the market at 8 a.m. Start trading 8:30 to 11 a.m. Right? Again, I'm making this like super mechanical because the reason being is like every successful trader needs like a solid trade plan that they can just follow. Now, like if I don't set these rules for myself, like I could find myself trading in the London session, in the Asian session. I'm less comfortable trading in those. The PM session as well, like which could be like a wild card. I mean, I've traded like a lot of golden opportunities in our PM session, like in New York, but it's just generally like it could be up, it could be down. We have no idea, right? So again, a lot of mechanical rules here just to keep our trading disciplined and make sure we're not sloppy, right? Times of engagement 8:30 to 11. Now we're going to input our key times, right? Our key times are going to be 8:30. Why? The news embargo is going to be lifted. The news embargo is going to be lifted at 8:30, so we can generally expect to see a manipulation actually happen at 8:30, and that's why I'm going to start scanning the market at 8 a.m., right? Because if I break the market down early, I'm going to be able to get into the manipulations ahead of time. So 8:30 is definitely an important time. I'm not going to be looking for a 9 a.m. Manipulation to happen, even though it is the new hourly open, just because at that point, like, we should be again consolidating for the New York Open at 9:30. So again, 9:30 is going to be one of our key times. That's going to be the New York opening bell. We have 10 a.m., which is going to be more news. Again, we can use that. And then generally, I don't really want to be trading like anything past 10 a.m., but potentially we could have like something happen like after that. Like reversals a lot of the time tend to happen at 10:30, so I will also be looking for potential reversals here. But I'm not going to be looking for like too much out of 10:30, and then 11 o'clock is just when like I will be getting ready to close my position. If my position is not closed by 11 a.m., but I'm clearly right on the position, I will hold after after 11 a.m. to hit my risk to reward target. So the entry technique is really simple. Buy in the here we go. Enter position on touch of the higher time frame PD array. So again, order block, breaker block, fair value gaps, and mitigation blocks, right? Less so mitigation blocks, but like they're still good on a higher time frame, right? So I'm gonna only do that, but I want to see equal highs or equal lows forming, like around or near, like relative equal highs, right? They don't have to be exact, but relative equal highs or equal lows forming at or around the PD array. So after a break of accumulated liquidity. Reason being is because this is going to be the market telling you, like, hey, there's like a bunch of stops here, and if we run those, we're more likely to have a reaction to that, and then we'll be able to take our trade in the higher time frame PD array. So, oh wait, hold on, I forgot to put this down. But first things first, like what we want to do is plot our higher time frame premium and discount, because we understand that like we're going to be trading in a range, and now like a true breakout, right, of a range is only gonna happen when we run like a high or a low, and then produce like a PD array at the high or the low. So that's gonna be telling you that a true breakout is happening. But otherwise, like every single breakout that most retail traders are looking for, we will probably be looking for a reversal there. So we only buy in discount, only sell in premium. This is super important. We never want to be long in a premium, and we never want to be short in a discount. Then, again, we can only enter, wait, I'm going to put this at the end, right? The entry, the end. Look for the break of accumulated liquidity. Time and SMT must be in line. So what does this mean? So with our times, we only want to engage after like one of our key times is being used. So again, your 8:30, your 9:30, 10 o'clock, and then potentially 10:30 here. And we have to have SMT. So time must be in line. Trade must have SMT. And so SMT is, again, like if we trade heavily correlated assets, one asset could be making like a higher high, one could be making a lower high. That's your SMT. It's going to be a crack in the correlation between your assets. It's telling you there's going to be institutional sponsorship in the potential move happening. So like every trade I enter has to have SMT, right? And then for my actual and for my entry technique, I'm also going to include things that like will validate it. So rejection of the higher time frame PD array, or a small retracement into it. I'm going to allow that to happen. Now, if like I enter at the higher time frame PD array and price is just chopping around there, I could take that as time distortion and hold on to it, but I don't really like it when price lingers around in a PD array before moving. Like I don't really like trading into time distortion, because the longer I sit in a trade, the more mental capital I'm going to be using. So like, yeah, it just doesn't, for me, like I would rather preserve my sanity than sit around and wait for price to do its thing. Does your accumulated liquidity have to be formed in the prior cycle? Yeah, like so. My accumulated liquidity could form in the prior cycle, session, day, year, month, week. It doesn't matter, right? Like it's just that there has to be relevant highs and lows there. So again, on the higher time frame scale, I'm most likely going to be using daily, weekly, and monthly like time frames to frame my narrative, and then on top of that, like if I'm using like something like the 4 hour, again, I want to see it accumulate liquidity there. But it just depends on like what the day looks like for me, right? And I'm gonna get into this like more in the actual like live trading, but this is just the essential basis of the trading plan we have here. So like I know I'm not going into too much detail with the accumulated liquidity. Like it could be like any high or low essentially, but I'm gonna try my best to find them on a higher time frame. So we have that, and then we're going to be entering our position on the touch of the higher time frame PD array. Our stop will be our stop is basically going to be like right after the PD array. So I mean, we're going to give the PD array a little room to react, because what could happen is inside the PD array you get a SMT happening. So another correlated asset might be making, like, let's say we enter a long, right? Another correlated asset could be making like a higher high, but your asset will be making a lower low. So stop will be placed directly after the PD array. Give it some room. 1 to 3 ticks, potentially after the PD array. And that's going to give our trade enough room to breathe if we're right, and if we're wrong, it's going to stop us out really quickly. This is why I'm going to use this trading model and this trade plan, is because if you're wrong, you're basically going to get stopped out right away, and as long as we manage our risk properly, we should be good to go. Now, for our entry technique on a continuation entry, again, we have the higher time frame premium, lower, like premium and discount coming in, only buying in discount, only selling in premium, right? Now, with this in mind, if we miss our initial entry at the higher time frame PD array, but the continuation entry looks really clean, what we can use is, I'm probably going to be using the unicorn model, but more likely like just breakers in general. Like, I really like to see a breaker happen, because, like, again, it's going to be an order block that gets violated and gets disrespected, right, after the initial change in the state of delivery. So what that's going to be telling me is I already have institutional sponsorship on my side. I should be looking for a continuation. So if that's the case, entry after initial move in a breaker block. I could combine the breaker block itself with like a fair value gap to give us the unicorn model, but I'm just going to be using the breaker block for the entry. Or, well, actually, no. We'll do breaker blocks, fair value gap, or order block. Let's do that. So our continuation entry after we have our initial soup entry is going to be looking for the continuation of the trend that, like, based on our narrative in a breaker block, fair value gap, or order block. Simple, right? We're not going to dig into that too much. Again, stop will be placed. Okay, here is where we're going to differ our stop, right? Our stop here has to be placed at the high or the low of the initial move, because this is going to give the trade room to breathe. So maybe like 1 tick after. Give the trade room to breathe, and make sure that even if we do have SMT, like at or near our breaker block, fair value gap, or order block, we're not going to get stopped out. And, well, damn, we made it to the end pretty quick, but I might add some more on top of this. If you guys think I missed anything, I should add anything, please let me know. I basically broke it down based on the event description here, but again, I know I might have missed some things. For the risk to reward view, we're going to keep it simple. 1 to 2 risk to reward. Now, I know, like, this might seem, like a little crazy, because I know you guys have seen market maker models do their work before. Like, if you enter at the low risk buy, low risk sell, you guys have probably seen 1 to 3s, 1 to 5s, 1 to 6s, right? The reason I'm doing this is because a lot of the time, a higher time frame PD array is going to be wide as hell. So what that means is that my stop is going to have to be like huge if I have to find an entry there. And trust me, like, I'm not going to be using like the weekly like fair value gap to enter unless it's small and I can give myself like a decent risk to reward there and the setup looks really good, right? But an essential 1 to 2 risk to reward gives me a good mechanical system to use, where every 2 trades that I lose, I can make back in 1 trade, right? And I'm going to be using like proper risk management here. So what does that mean? We're starting with the 150K static account, right? So that means we have 1250 in drawdown that we can take on. Well, I mean 1254, but I'm not going to count that $4 that I did with my test trade just to make sure the account was okay. We have 1250 drawdown, right? What I want to do is have every trade only risk $125. So I'm going to be trading micro contracts, obviously, but every trade should only risk $125 or a little more than that on micros. And what this is going to allow me to do is limit my risk, make sure I don't blow the account too quickly, and then every trade that I win, I'm going to be making 250 back, or maybe a little more than that, maybe like 260 or something like that. But it's just a mechanical way to make sure the account doesn't get blown. Now, I know like a lot of people could take a more, like, I mean, I've seen it, right? A lot of people could take a more aggressive approach, like maybe like risk $250 a trade. And like I've seen it happen, I've done it. I mean, at one point on like another static account I was doing, I was risking like $500 a trade on like the 1250 drawdown, right? But I mean, I was super confident in those trades, and I hit my, and I wasn't using like the 1-to-2 risk to reward ratio. I was using like a 1-to-3, 1-to-4, something like that. But again, a more mechanical method allows me to limit my risk and make sure that the winning trades win and the losing trades are paper cuts. So for profit taking, oh, there it is. Something I missed. Here we'll dupe this. Trade management. So we're gonna have our profit taking. Where? Okay, do they not have the? Oh, here's it. The toggle list. Okay. Taking right. Okay, so profit taking is, I have to take profit at a 1-to-2. Because the only reason the trade is going to make sense is if I do that. The only way it actually works out in terms of like a decent risk to reward is if I take profit at the 1-to-2. So what that's going to look like is like I'm just going to be holding the trade throughout. Like as soon as I enter, I have to hold it. I'm not going to take profits at a 1-to-1, like no matter what. Oh, yeah, Rob, that's what I mean. Like, so if a candle, yeah, like for a breaker for me to enter on a breaker, I need the candle to close above or below it, and then enter on the next candle. Yeah, thanks for pointing that out. Yeah. No, it has to be a solid close above. But, yeah, back to profit taking, right? I have to take profit at the 1-to-2 RR. I'm not going to take a profit at a 1-to-1 RR because at that point, like, the trade doesn't even make sense. I'm not going to be, like, exposing myself in that way. But as soon as the 1-to-1 RR is hit, well, actually, this should just be, I need to delete this. Here, we'll copy these two. I'm just going to put like my general trade management here. Okay, if it'll let me highlight these. Boom. Okay. Move stop loss to break even. So again, this is part of a mechanical system, right? As soon as it like price taps that 1-to-1 RR, like, and again, like every trade, I'm going to set an alert at the 1-to-1 RR so I know stop loss is going to be moved to break even. Why is that? So it gives us a risk-free trade and allows us to hold on to our position. Now, what this system is going to do is sometimes it's going to stop us out at break even, right? And that's okay. Like, that's part of it. I'm only going to take a small like paper cut loss if I do, just from like commission fees, but that'll be like, you know, $5-10 on like this initial 1250 drawdown, and it's going to allow me to, you know, keep going. And sometimes like that happens. Your position will reverse out of nowhere. It is what it is. So yeah, a 1-to-2 RR is going to be exactly what I'm going to be looking for. And yeah. And then as soon as we confirm a fast approach to 1-to-2. So as soon as we can confirm, like this is going to be, again, algorithmic footprints, right? We're going to see a lot of fair value gaps getting created, a lot of big moves, like very quickly, right? As soon as we can confirm a fast approach to that 1-to-2 RR, we are going to be moving our stop 1-to-1. Now, again, like I said, like I wouldn't do this, but there's been a lot of times where, again, like I could be targeting liquidity in a like right above, again, like that like our rejection blocks, right? And then price just dips down from the rejection block. I mean, if we can get a fast approach up there and it looks like it's going to hit it, I will move my stop to a 1-to-1 RR. So in that case, like if it does reverse, I'm going to be safe and I'm going to be in profit there. But I'm generally not going to do this. Like just about like 80-85% of the time, I'm going to be setting my take profit at the 1-to-2 and just letting it rip, right? So in terms of like general mindset, oh, that's what I forgot. The more you know. In terms of risk operations, here's what we're gonna do. Okay, after 2 wins in a row, if I take 2 trades in a day, even, right? If after 2 wins in a row, exit the chart. After 2 losses in a row, exit the chart. Most of this is just going to come down to trade discipline, right? We're going to try and stay out of the chart as much as possible. Oh, yeah, I forgot to put which ones I'm going to be trading. So hold on. I'm going to put... Okay. We are only going to be trading 2. We're going to be trading the NASDAQ. So I'm going to be doing this on futures. So this is going to be NQ. And we are going to be trading the Dow Jones. This is going to be YM. I'm only going to be trading these. And then using ES and the dollar index for additional SMT. But I'm only going to be trading these 2 right here, the NASDAQ and the Dow Jones. No, I can't trade gold on this account, Joker. Like, there's just no way. Like, every price swing on gold is going to lose me like $100 at least. Like, I just can't do it. Yeah, no, there's absolutely no way I can do that. But yeah, after every 2 wins in a row, exit the chart. 2 losses in a row, exit the chart. I'm going to be executing using Tradovate. So again, I have that linked to my trading view. You guys will be able to see all the trades live. And again, not financial advice. Please do not take my trades. Yeah, so mitigation blocks by themselves are like swing lows and highs, right? So they're essentially like breaker blocks, but what makes a mitigation block is that it's a failure swing, so it fails to take liquidity, right? And then breakers are the ones that do take liquidity. I like to use breaker blocks a lot more than mitigation blocks because to me, like they just work better. My pleasure. All right, so again, 2 losses in a row or 2 wins, exit the chart. And then 4 wins in a week, finish trading for the week. So that's going to be, yeah, actually, like I'm just gonna set it to 4 wins in a row and 4 losses back to back, or it could just be in a row. This is gonna, like, again, all of this is meant to keep you out of the market because, like, the more time you spend in the market, the more ideas, like, you're just gonna get. Like, if I stare at the chart, like, let's say today, if I just open the chart right now, it's 11:51. We're out of the kill zone, right? But if I open the chart right now, like, I'm gonna start getting some ideas. And like, next thing you know it, I hit the button, I'm in a trade, and I'm probably gonna lose it because, like, time isn't aligned, price probably isn't aligned, and I'm just not trading during, and I don't have like a real model. It's just going to be based on what you see in the chart. I'm not trying to do that. I want to have like proper mechanical risk rules and make sure that any trade I take on is following these. An inside day, so essentially like it's going to be an inside day if the previous day's low or previous day's high hasn't been taken, right? So that means the order flow is going to be trapped. A lot of the times what inside days look like is if you go to like the 1 hour chart, you're not going to see like a bunch of PD arrays forming or like any good PD arrays forming, especially not on like the 4 hour or something like that. Like, so that means that your session is like more probable to be choppy, and I would rather just not trade that. Rather let price digest and move on. Right. So, okay, yeah, I'll answer that question, Lamp. No problem. Managing risk is really hard. If you have like a smaller drawdown, right? But you have to think about it in terms of like not a percentage, but in terms of like winning and losing. So if you take for example like this risk to reward, right? So what do I have? 1250 drawdown, right? So again, like I'm risking 10% of my actual drawdown as opposed to like 0.25 or 2% on an account. You have to be looking at the drawdown as the amount like the account actually is. So realistically, I'm not trading with a $150,000 account. I'm trading with a $1,250 account. Does that make sense? Right? So when we take a look at something like that, we can understand that if I have 10 losers in a row, 10 trades that I lose in a row, I am going to be completely killed on this account challenge, right? But, like, is that likely to happen? I mean, maybe it could, right? Like, I can get super unlucky, lose 10 in a row. But what do my risk rules do? They stop me trading for a week after I have 4 losses, and then I can refresh myself on the next Tuesday, next week's, the next week's, like, true open, and I'm going to be able to, hopefully get in the right, like, mind space. And, like, let's say, again, like, I do lose 4 trades in a row, right? With this 125, like at the start of the challenge, right? So how much is that going to be? $500, right? If I lose that $500, guess what? 2 trades that are wins bring me back to break even. So it's essentially going to stop me from losing too much. Does that make sense? And yeah, so like with the initial drawdown of like 625, it's going to be pretty difficult. Like I know to properly risk on those trades. That's why I don't like the 100K static. The 100K static is just, it feels like you don't have too much room to breathe on that one. Like you could only lose what like 5 trades in a row if you risk 125 per trade. The profit target. Okay, yeah. So my profit target, I'm not going to be targeting buy side or sell side or like anything like that. Like every trade is just going to be a 1 to 2 risk to reward. And for narrative, again, the biggest thing is trade with the trend. Now, like I know a lot of people are like going to be looking at this like, how do you know like you're trading with the trend? Basically, if like on the daily, weekly, or monthly, it says we're bullish, like that you see bullish order flow, you see a bullish change in the state of delivery, trade longs. Only trade longs. And don't take like the mini micro shorts that happen during the day because it doesn't really make sense for you to do that. You're still going to be trading against the market. Oh, the account's profit target. Sorry, my fault. Okay, so the profit target on the account is $4,000. Profit target. So theoretically, I forgot to talk about scaling. Okay, that's something we have to add. Look at that. We're just adding a bunch of shit to our trade plan that we didn't know we had. But yeah, those are the risk rules that are going to be right there. Oh yeah, and entry technique, I'm also going to put the time frame I'm going to be using. So again, I'm only going to be using these time frames to enter, nothing higher, nothing lower. Okay, A static account means the drawdown is fixed. So essentially, like what that means is um is that like the 1250 drawdown that I start with. So like if I start with the 150K, right? Like what does that mean? Like my account is gonna be liquidated or like failed at $148,750 in the equity balance, right? So versus a static, a trailing account, which means that like every single time you take on unrealized profit, so that means you're going up and you're green on a trade, your drawdown is going to follow you. So if I start with a 50K trailing account, right, which normally on most prop firms, I think starts with like a $2,000 trailing, right? It means like if I'm green like $300 on a trade on that trailing account, right, my drawdown is also going up by $300. And then if I don't fully take profit at that $300, my drawdown is going to remain the same because it's going to be based on unrealized profit. I don't really like that, even though I have a couple of funded trailing accounts. So, but like I'm trying to focus on the static accounts because like I'm just more comfortable with those, and they're a lot better and easier to trade for like this strategy at least. Because on a trailing drawdown account, I'm probably going to be doing like a 1-to-1 risk to reward per trade, just so I can like take profit. And like you need to apply like a completely different strategy when trading a trailing drawdown just to manage the trailing. Well, I mean, no, for a static account, like once I'm green on a trade, like it doesn't matter if like the trade like reverses or goes back down, my drawdown is not going to change. So like what's profit is profit, right? What's not, like if I go up again like $300 on the static account, it's like my drawdown doesn't move with it, but it just increases. So essentially, yeah, like I would have more cushion, but it just depends on where I take profit, right? If we don't make it to my profit target, let's say we hit the 1-to-1 and then go back to break even, I'm not losing drawdown for that. I'm not losing like breathing room. What was I gonna say again? Oh, scaling. Yeah. So yeah, these are the essential risk rules right here, and then scaling. So as soon as we hit, let's go with an extra 1K, right? So plus 1K in equity equals $250 max risk per trade. We're going to scale. So basically, like if I was trading 5 micros before with $125 risk, now I'm trading 10. And this is going to allow us to get to our profit target faster. And it's my favorite way of just breaking down account challenges and making sure like I don't spend too long like dilly-dallying with the account challenge, because theoretically, like if I win 4 trades in a row, I get that plus 1K, right? And if I continue doing that with that $125 max risk, like I could do it like no problem. It's just going to take like a lot more trades, right? And I don't really feel like I need to do that many trades. I don't want to pay the monthly fee on the static account, so we're going to be scaling in this way. Actually, I'm just going to set it to this, right? Because this is pretty good. With a $250 max risk per trade, what does that mean? It means that I gain 500 on every trade that I win, and every trade that I lose, I only take that $250 loss. So I'm just going to keep it at that after 1K in equity, and then that's how we're going to scale to our 4K profit target. Because, I mean, if we think about it, right, if we only have that 1K, if we have that 1K additional 1K in equity, our drawdown is going to be $2,250. So $2,250. We're going to have about, I want to say 9 trades to lose in a row to actually lose all of that equity, right? And to liquidate the account. Now, if I lose 9 trades, and I can't even lose, I could lose 9 trades in a row theoretically, but not in the course of a week or even 2 weeks, because again, 4 losses in a row, you're done trading for the week, right? So with that in mind, that's how I'm going to scale. I could do another like scaling, so add on risk, like maybe $500 max risk per trade, like for after 2K in equity. But I'd rather just not do that. Like, you want to play it safe with these, because if I do like the $500 per trade, it means I only have 4.5 trades to lose, to actually, you know what I'm saying, like lose the account. Like, that makes it a lot tighter. It gives you a lot less breathing room. You want to be as comfortable as you can be, like when you're doing like these funded challenges, these evaluations, because like if I put all my risk into one trade and then it doesn't work, what am I doing? I'm paying $75 for another reset. That just doesn't make sense. Like, you need to find a mechanical way of managing your risk to where you're not taking on too much, but you're not taking on too little. Static accounts, I mean, no, they don't have a time limit. Like for ETF, I'm going to be trading with Elite Trader funding on this one, but I do have to pay every single month a $75 fee. And like, it doesn't reset the account or anything. It's just going to keep the account at the same equity, but I don't plan on, you know what I'm saying, like taking like 6 years to finish this account and giving up like a dumb amount of money like per month, right? And yeah, I think that should be just about all of it. Does anyone have any questions in terms of this trade plan, or is this good right here? We'll review it real quick, actually. So we just have our brief concept breakdown, turtle soup, buy and sell, right? We're going to be using the higher time frame PD arrays as our entry model. Market instruments, we're only trading NASDAQ and Dow Jones, and then using the ES and the dollar index for SMT. Rules of engagement, again, no trading Mondays or Fridays. No trading on the day of high impact news, or after Wednesday of NFP week. No trading outside of our kill zone, which is going to be 8:30, starting at 8:30, and then no trading inside days where the order flow is actually. I really sometimes I don't like this rule, because inside days, like if we get the manipulation at the New York session, we're gonna be able to find like good expansion, or yeah, like we're gonna be able to find good expansion towards the previous day's high or previous day's low. So I'm actually gonna take out this rule. But I mean, again, like if we have a super choppy like inside day, and like the New York AM session is choppy, like starting at 8 o'clock, I'm probably not going to be interested in that. Or sorry, not like if it's expanding, but then like it's like pausing in between, I'm not going to be interested in that. Prior session, again, should be choppy for me to engage. Should not have like a huge expansion overnight. That's really just what I don't want to see, a big ass expansion overnight. Oh, you said really curious what that will look like. Like, what you mean, like the trading challenge itself? Yeah, I mean, I'm also curious because. Right. No, I understand no, it's not the definition of the sell stops and the buy stops. I'm just saying, like, it's the concept of it. So like buying at or near the buy or sell stops, like that's like essentially it, right? I'm gonna be buying inside the PD array. So I'll put inside higher time frame PD array. Make everybody happy here. You guys will be able to see this notion as we go, but thank you for pointing that out, right? Elements of market structure we're going to be using is just purge and revert. So liquidity purge, liquidity revert. We're going to be trying to go from buy side to sell side to buy side. We're going to be using higher time frame market maker models to analyze the market. And I'm going to put 1 hour and up, just because like sometimes you can get a nice 1 hour market maker model as opposed to a 4 hour. Sometimes you're not seeing it. And then, yeah, like we're only entering off of fair value gaps, order blocks, breakers, or mitigations. Narrative, we're always going to trade with the trend. Only long when there is bullish CSD. Okay. And like this is generally what I'm going to be looking for. I want to see either a retracement of London's like expansion, hopefully, preferably, it's not too large if London does expand, or have like a nice manipulation happen to give us our daily expansion in New York. And in times of engagement, again, we're going to start at 8 o'clock. Entry technique, we're going to buy in the higher time frame PD array, stop just outside of it. Again, continuation entry is essentially going to be just the first breaker block, preferably. If I can't find that, I might look into a fair value gap or order block entry, but I generally don't really want to take continuation entries. I want to get the initial entry, but we'll see. And then account drawdown, I broke that down to you guys. I have 10 trades that I have to lose in a row to lose the account, to fail the challenge. $4,000 profit target. Trade management is just going to be a 1 to 2. Very simple, very mechanical. Trade examples. I'm not really as interested in breaking down like what it's going to look like before I get into the trade. Rather, all of this is going to be recorded, right? So when I do trade tomorrow, I am going to be trading this challenge itself live, right? When I do trade tomorrow, I'm going to be looking for just a live trade to show you, because if I only show you an example, it's more like it could be like a nice hindsight trade. But I mean, you know what? I'll actually find one right now. Hold on. We've got something. I mean, here we have. Okay, so here, let me just copy this and then throw it in. Now, I'll give you an example so you guys understand what exactly we're looking for here. Go. Okay. That should be it right there. So if we take a look at this, we can see we did take the previous day's low right here. This is a trade I framed on the hourly time frame. So again, we can see we have our higher time frame order block that gets formed there. We also have a fair value gap in place. Wait, you guys can see this, right? I'm not bugging out. Yeah. Okay. So yeah, so we have our order block here, right? We have a fair value gap inside it as well. And then as you can see, price does the expansion downwards overnight. London session, you get that small reversal at around 8 o'clock. 9, starting the New York AM session, we get the retracement of the overnight move into the order block. And we can see, if you just entered there with the stop above, that is, around 25 points of drawdown we would have taken. Well, I mean, for the risk we would have taken on for the trade. And it was a nice 1 to 2 right there. You get 50 points out of it really fast. Again, I could have held it for longer, but this is just an example of this in action. And this was, you can backtest this for yourself, May 31st. Yeah. But that's going to be our example. We have our risk rules in place. 2 wins in a row. 2 losses in a row. Boom. Simple, mechanical. We have our scaling. That's it. Does anybody have any questions? I feel like I was pretty straightforward with this one. We start trading tomorrow. It's going to start at around 8 a.m. I hope we could pass this one. I hope I don't lose 10 trades in a row. That'd be crazy. Well, I'll see. Like, I'll try to go live for every session. Sometimes, if I have prior engagements, like I do, sometimes have to take the niece to school. So, if I can't make it, like at that early, if I can't go live, then I'm just gonna try and record the live trade, and then post it after. And yeah, and I mean, like if I find the time as well, I'll also do the post trade review. So we'll do like a daily review or something like that after. But yeah, that's about it. I'll be able to answer like any questions you guys have now, and we will start tomorrow. Thank you guys for tuning in, though. Thank you guys. I'm gonna have this recorded. I don't know where I should exactly post it. Maybe Zusi will help me make a channel for it. But yeah, we're gonna be starting tomorrow. Thank you guys again for tuning in. If nobody has any more questions, I will be ending our stream. Let's do it. See you guys in the market tomorrow.